Good afternoon and welcome to BizTech's Asian Midday Market Watch. It's the 30th of August. I'm Brian Fernandez, and let's start by taking a look at a summary of market action. Now, overnight in the US, the Dow Jones Industrial Average climbed to a new record, up 0.59%, closing at 41,335. Now, gains in Goldman Sachs, Intel, and Visa helped to lift the blue chip average to a new high. Now, the S&P 500, however, ended the session just below the flat line, but the Nasdaq Composite slid 0.23%, dragged by shares of chipmaker Nvidia, which slid 6.4%. Now, Asia-Pacific markets today climbed after economic data from the US calmed the recessionary fears, while investors also assessed a slew of data from Japan. Initial jobless claims in the US fell to 231,000 from the prior week's 232,000, but was slightly higher than the 230,000 that was expected by Dow Jones. In addition, the recent second quarter gross domestic product growth was revised higher to 3% from the initial 2.8% rate. The inflation rate in Japan's capital city, Tokyo, rose to 2.6% from June's 2.2%, hitting the highest since March. The core inflation rate, which strips out the prices of fresh food, rose 2.4%, which was higher than the 2.2% expected from a Reuters poll of economists. Tokyo's inflation is widely considered to be a leading indicator of nationwide trends. Now, stronger inflation numbers offered the Bank of Japan more room to tighten its monetary policy. Unemployment in Japan also rose to 2.7%, more than the Reuters estimate of 2.5%. Now, retail sales in the country rose 2.6% year on year, lower than the 2.9% growth expected by Reuters and the revised 3.8% increase in June. And that's it for today's market insights, market summary. Now, to give us greater insights into what's happening in markets, we have Kelvin Wong, Senior Market Analyst at Oanda, coming to us out of Singapore. Now, Kelvin, great to have you on the show.
Hey, happy Friday, Brian, and good to see you again.
Happy Friday. Now, talk about Happy Fridays. Japanese CPI numbers came in, or rather, Tokyo CPI numbers came in better than expected. What's your take on the numbers?
Sure. So if you look at the situation right now in terms of inflationary pressure in Japan, it seems to us that things have started to kind of normalize more on the upside after a slight decline that was seen earlier at the Q2 of this year in Japan. So even the core Tokyo inflation CPI, that means taking out of the effects of fresh food and energy costs, that actually rose as well for the month of August, 1.6% year on year from 1.5% year on year in July. So that actually increases the odds, or I would say give more reason for Bank of Japan to actually stop quantitative easing in Japan and slowly starts to normalize its decade plus of dovish monetary policy. And potentially we could talk about another chance of an interest rate hike coming in Japan before 2024 ends, and given the fact that the US Federal Reserve right now is at the start of kicking off an interest rate cut cycle coming up from the upcoming Federal Reserve Monetary Policy FOMC meeting in September. So that should actually kind of negate off the potential negative impact from a kind of a rather lukewarm hawkish BOJ monetary policy.
Now, Calvin, on a different note, let's take the US stock market. What do you make of the state of the market, especially after Nvidia's earnings results, which, despite being great, basically resulted in the stock falling quite sharply?
Sure. So if you look at Nvidia yesterday, it was disappointing. I mean, in terms of their results, and it also causes a negative feedback loop into its key impacted major US stock indices, which is the S&P and primarily on the Nasdaq 100, given the fact that Nvidia has a 6% market cap weightage on the S&P 500 and a much more a heavily weighted market cap weightage of 8% in the Nasdaq 100. So what we could see over here is that, yes, even though Nvidia actually saw a sell-off in yesterday's price movement, but however, the broader US market didn't actually got a hit. All right, that means in fact, we look at other sectors of the US stock market that has been lagging since the pandemic period until now. That means, i.e., the industrial sector, the healthcare, the real estate, and primarily also the energy sector. All this particular sector actually rose yesterday and outperformed, and that actually led to the Dow Jones Industrial Average hitting a fresh all-time high yesterday. But without seeing a fresh all-time high that was seen on that is being printed on the S&P 500 and the Nasdaq 100. So what we could see over here is that this typically kind of price movement seems to be pretty much healthy in my perspective, where we start to see a rotation back into the prior laggards. That means, i.e., from an index perspective, would be the Dow Jones Industrial Average and even the Russell 2000 as well, which actually outperformed yesterday against the Nasdaq and the S&P 500 by notching up a daily gain of 0.7%. And that is also being supported by two factors that is in mind right now, market participants got to be aware of. Is firstly, the US Federal Reserve kickstarting a interest rate cut cycle after being delayed for close to about 3 to 6 months. And also, on the other hand, is that key economic data out from US is now showing less odds of US slipping into a recession. So that actually causes the bull steepening of the US Treasury yield curve. So if you recall, in somewhere around in 2022, everyone was pretty much afraid of that US Treasury yield curve inversion, where not right now this inversion is no longer is in place in the market. In fact, right now we're talking about a bull steepening phase, where the 2-year Treasury yield is falling at a faster rate than the 10-year Treasury yield, causing the yield curve back into a positive territory right now. And that is actually a big if, is unless we get to see more and more data coming to support of a lower odds of a US recessionary scenario. And if this continue to play out, the bull steepening yield curve will actually steepen much further, which is potentially we will see much more rotation back into the laggards. That means we talk about the industrial stocks in US, financial stocks in US, healthcare stocks in US, and from an index perspective will be the potential outperformance of Dow Jones Industrial Average and Russell 2000 over the high-flying mega cap technology heavily weighted index like the S&P 500 and the Nasdaq 100.
Now, Kelvin, looking ahead to today, all eyes are on US PCE inflation numbers.
Yes.
What are the expectations for the market?
Yeah, of course, if you look at the current expectation right now, given that the core PCE price index, due to the seasonal factor, has been inching down much lower in the last 4 to 6 months. So last month, for the month of June, it came in at 2.6%. That's actually stripping off energy and food price. We're talking about the core PCE price index. So on a year-on-year basis, market is expecting a slight uptick of 1 basis point to 2.7%. So let's say if the index came in within market expectation or come down slightly weaker at around 2.5% year on year, that could actually further cement or further increase the odds of a much more dovish stance that the Fed could actually undertake to kickstart the first interest rate cut coming in the September FOMC meeting. And that also could potentially see further weakness on the dollar, given that the dollar has slid to almost close to a year low based on the dollar index right now.
Now, Claudia, on that note, thank you very much for your insights and thanks for coming on the show.
My pleasure.
Now, we've been speaking to Kelvin Wong, a senior market analyst at Oanda. And this has been BizTech's Asian Midday Market Watch. I'm Brian Fernandez. Check out the show on our website, www.biztech.asia, as well as our syndication partners, TV stations, radio stations, and websites. Thanks a lot for tuning in.